You're watching episode 38 of the Tax Smart Daily, a daily video series for real estate investors to learn how to be tax smart. Before we get started, make sure to subscribe to our YouTube channel and click the bell icon to receive notifications about future videos that we release. Thanks for tuning in to another episode of the Tax Smart Daily. I'm Brandon Hall, and I invite you to join our Tax Smart Facebook group and our Tax Smart newsletter. Links to both of those are in the description of this video. Today's topic is about self-rentals. Specifically, if I run a business and I run it out of a piece of real estate that I have purchased, can I cost segregate that real estate and claim the losses against my business income? Now, intuitively, you might say, of course, because your rental real estate, if you're renting it to your own business, then it's part of the business, and you should be able to take whatever loss comes from the rental real estate and write it off against your business income. The problem is the self-rental rules. These rules exist to avoid any sort of abuses with shifting income out of one category and into another category to avoid certain types of taxes. So a business that rents to itself will get a self-rental deduction, or will get a rental expense deduction, and that will be subject to the self-rental rules. On the real estate side, that's going to create income for the rental property. After depreciation, if you still have net income, that net income is non-passive. But here's the kicker. After depreciation on the rental side, and after all of your expenses, if you have a net loss, the net loss is passive. So even though you're renting to your own business, that rental loss from the rental real estate is passive. And if you don't have any other passive income, or if you don't have gain on sale from a passive activity, then that passive loss is suspended and carried forward, just like every other passive loss. Because remember, rental real estate by default is passive unless you qualify as a real estate professional. Now, there's a cool thing that you can do with self-rentals. You can make an election to group the rental activity with your business. And what that will do is it will make all income from the rental activity non-passive and all losses from the rental activity non-passive. So you can buy a piece of real estate to house your business. You can rent to yourself. You can do a cost segregation study and create a very large loss from the rental real estate. And you can make that rental loss non-passive to offset your business income and any other type of income, as long as you make that grouping election. If you don't make the grouping election, you are toast. You cannot, it's a first year thing. You got to be really, really careful to make sure that you make that election. So when would you use this? Anytime that you're going to buy commercial real estate for your own practice. We see this a lot with physicians buying surgery centers that they also use, or buying stakes in surgery centers that they also use. Guess what? You can group that stake of that surgery center in with your own business, your own practice, and you can use the rental losses to offset your practice's income, as long as you make the election to group them together as one activity. Now, the cool thing about this is that you don't have to qualify as a real estate professional to make this happen. You just have to make sure that you make the appropriate grouping election to group the self-rental with your business activity. Thanks so much for watching another episode of the Tax Smart Daily. If you have any questions, or if anything that I say resonates with you, please drop me a line below in the comment section, and follow us online. We have tons of places that we're posting content. All of that's in the description of this video. And like I said, join that Facebook group.